excited to be for once another time at Capital Link Forum after 2 years. First of all, congratulations to Olga and Nikos for an excellent coordination and another successful forum. 2 years ago, I was moderating a panel for real estate. We were discussing about the turnaround of the Greek economy and the next steps for Greece to regain investor confidence. 2 years later, a lot of things have changed. The global environment is shaped by geopolitical tensions that have threatened financial stability at global, regional, domestic level. Yet Greece has managed to avoid or absorb most of the negative externalities at the macro level. The return to investment grade has generally reinforced the credibility of the country and reduced the sovereign risk premium. The Greek banking system is more resilient than ever before, achieving the lowest NPL ratio since Greece joined the euro area, and this is combined with strong capital buffers and presumably a renewed interest from global institutional investors. So, has Greece got that vote of confidence, or does it worth that vote of confidence? I can assure you that we'll all be wiser upon giving the floor to the distinguished speakers that I have the honor to moderate, and I'm going to give them directly the floor. From your left to right, Iason Kepaptsoglou. Iason is Head of Investor Relations at Alpha Bank. His involvement with Greek banks began 10 years ago following roles with local banks in Spain and Italy for HSBC, later covering Scandinavian banks and subsequently multinational banks in Southern Europe. Mr. Alex Blades, who does not need many introductions, is a partner of Paulson and Co., the renowned private investment company specializing in global investment arbitrage and credit strategies. Alex leads Paulson Investments in Greece with a focus on Greek banks, and being a non-executive director at Piraeus Bank, he has contributed with the management team to achieve one of the world's best bank transformations. Last but not least, Mr. George Katsikas is a managing director and member of the financial institution group at UBS's investment bank based in London. He is responsible for FIG franchise of UBS in Greece, Cyprus, and the broader Central and Eastern Europe, and he is in charge of coverage of major private equity firms. He has involved in almost all key strategic transactions that have taken place in the Greek banking system over the past years, and I think that those introductions promise a very interesting discussion. I will shuffle a little bit the deck, and I will start with Alex. And the first question is that Greek banks have recorded significant appreciation in the stock market. And of course, at that point in time, we have seen banks almost doubling their value, but we have an average of at least 70–80% this year. The question is, after such appreciation, is the stock market still an attractive proposition for public market investors?
Thanks, Jan. Yes, undoubtedly they still are attractive. I think in the European context, the context of European banks, they very much stand out. I think Mr. Zanias in the previous panel laid out the metrics very well, but if you take an example such as Piraeus Bank, I think those metrics speak for themselves. One thing I would focus on in particular, which maybe wasn't given quite as much emphasis, is just the loan growth that's taking place. In the 9 months to September 30th, Piraeus Bank, for example, and it's consistent with the other banks, grew the loan book by 15% year over year. And that compares to an average of very low single digits in the rest of Europe. In some countries, you've barely got a heartbeat. So the loan books are growing very fast. We have NIMs of 100 basis points over the average in other European countries. We have, as Mr. Zanias mentioned, very significantly, very low cost bases, so about 35% cost to income. You compare that to 50 or 60% in the rest of Europe. And returns on tangible book, about 15% compared to about 11% in the rest of Europe. So if you take banks which are earning similar returns in other European countries, they're trading at about 10 to 11 times their forward earnings, whereas a bank like Piraeus is only trading at about 7 to 8 times. So if Piraeus were to trade in line with banks which have similar earnings power, you're talking about 30 to 40% upside from there.
I think that's a very compelling argument, but I would like again to go to George and ask your view for the analysis that Alex presented, especially if you think that current prices reflect macroeconomic assessments for Greek banks. But most importantly, a quick statement for that, I would like to ask you, as a leader of the FIG franchise, I know that you have a deep and broad knowledge of European and universal bank players. What is their interest in the Greek banking market, and what are the prospects for a strategic acquisition?
Thank you, Yanni. I think I'm going to repeat a little bit of what Alex said, but it's important to see what these guys observe when they see Greece, right? From the outside in, the potential strategic acquirers, and they see an economy that's growing at 2.5%, which is, as many of our colleagues earlier said, it's more than 2 times the European average. They see a very well-structured market, which is 90% controlled by the 4 systemic banks, which means that they have, very sticky deposits, very good NIMs, as Alex said, 120 basis points better than the European average. And then on top of that, you see fees effectively being totally underpenetrated. You have 20% as a percentage of total income, as opposed to 30%, which is the European average. So, in this spirit, I think the question is whether this fits to the strategic agenda of the acquirers, right? You saw effectively UniCredit doing a deal, and I wouldn't be surprised if I see more coming in the foreseeable future.
Okay, and I think that you give me a good assist to continue with Jason. Of course, strategic acquisitions are the next level from a strategic partnership, and at your bank you don't have yet a strategic acquisition, but the acquisition of a larger stake from UniCredit has been heralded. And therefore the question is, from your role, what do you think that UniCredit has seen that the public market investors should also be noting for Alpha Bank?
Look, there's clear tangible benefits to the agreement we have with UniCredit. I think it's important to have a bit of history with regards to how this began. There was a shared vision about cross-border collaboration between the two organizations and sustainable growth. This has started as a joint venture in Romania, but thereafter also a stake of 10% in Alpha Bank. Now that's increased to just under 30%, which is a sign of confidence in the Greek economy, in the prospects for Alpha Bank, and in the value of the partnership itself. It's not just an investment, it is a strategic alliance, as you put it. It's built on trust, on collaboration, and a commitment to deliver value for all shareholders. The partnership is a core strategic pillar for Alpha Bank. It brings some very tangible benefits. We're able to service our clients in a much wider network of 15 countries, so we become the preferred partner for them. There is an enhanced offering through initiatives in trade finance, in transaction banking, in FX payments, that gives us measurable growth, and also allow us to deepen the relationship we have with our corporate clients. And we're also able to participate in international syndications led by UniCredit, giving us some healthy diversification benefits. We're also able to offer our affluent customers an expanded offering through the One Markets platform that UniCredit has brought to Greece. And we're also seeing operational benefits. The relationship has kind of organically grown into a knowledge exchange between the two organizations in upskilling, reskilling, in operational resilience, in procurement, in cybersecurity, stuff that competitor banks usually don't talk about. And let's not forget, we also have a stake in the 3rd biggest bank in Romania now. And we're able to co-invest in its future development. This isn't a one-way street, right? UniCredit is benefiting greatly from this partnership as well. They've gained access to another market in Greece, and they've strengthened their foothold in Romania. They've unlocked new opportunities in sectors such as hospitality and shipping, where we are collaborating in advisory in capital markets. They're expanding the reach of their product factories through the accelerated fee income growth and the products we're able to place for them. And it also supports regulatory objectives. They're fostering cross-border collaboration under a slightly different model. That's not it. This is where we currently stand. There's more potential in the future. We can scale the international syndication business. We can expand the infrastructure on transaction banking. We can continue deepening the capital markets collaboration. This is, after all, a catalyst for growth, for innovation, for regional leadership. It's a different model of cross-border collaboration, and it's delivering value not only to shareholders, but also to our clients, employees, and the broader financial system.
Okay, and you referred to capital markets, and right now the momentum for the Greek banking system aligns with the transformation in the Greek capital markets. The successful completion of the tender offer of Euronext for the acquisition of Hellenic Stock Exchange is expected definitely to bring an additional higher trading volume, significant liquidity, more visibility to investors, and in any case, even potential passive flows of income. Also, Athens is going to be upgraded to a developed market. Therefore, Greece's momentum seems to have a rare combination of political stability, banking strength, and capital market transformation, an active stock market. In that framework, Alex, to return to you, what is the role of macro for the Greek banking system, and what role does macroeconomics play in the investment thesis for Greek banks?
Well, it's absolutely fundamental. It's often said the banks go where the sovereign goes. So, of course, we experienced this with great clarity over the last 10 years in Greece. I think it has to be stated very clearly that the performance of the administration of Kyriakos Mitsotakis and New Democracy is key to the investment case. And we heard this expressed very clearly at the lunch by the Deputy Prime Minister. A very rigorous, business-friendly, but fiscally prudent approach to governing. Business-friendly, but fiscally prudent. And if you think about it, it's becoming quite difficult to find that combination in the world these days. So it's really a breath of fresh air that we find it in Greece. And it's the reason why we have fiscal surpluses. We have growth rates above the European average. We have the sharp decline in unemployment. We have tax reductions for households and businesses. All of these things combined are creating an environment that's conducive to investment. It's the environment in which the banks operate, and therefore provides an opportunity for them to flourish, and it's attracting the capital. Perhaps the clearest market indication of this is the spread, the sovereign credit spread. And as we've all observed, Greece is now trading inside of both Italy and France. But to link it back to my earlier comment, what's interesting is that we have a situation where Greek banks, on average, have a market-implied cost of equity of about 13%. And yet the average Italian bank has a market-implied cost of equity of only 10 or 11%. So, and this is in a scenario where the sovereign risk premium is the reverse. So this seems to be, is out of whack. And I would expect that as confidence grows in Greece's ability to deliver, as this government stays the course, as the economy and the country stay the course, that this difference in the costs of equity will contract, and this will also be expressed in Greek bank equity prices.
Okay, so I think that the momentum in the banking system and the capital markets is facilitated from the political stability that brings practically, as I understand from your perspective, a resistance to the global, let's say, negative externalities of the global macro. This is impressive for Greek market. Again, I'm going to switch to George. And now Greek banks are expanding their portfolios to try to find new products, and we have seen some moves in bank assurance, in captive insurance offerings. Therefore, how do you see these moves changing the attractiveness for an investor perspective?
I think there were moves in the right direction. As I said before, there is a gap of roughly 10% as percentage of net income to be captured or to be pursued in terms of non-NII. And obviously the insurance businesses that Piraeus bought and Eurobank internalized again head towards that direction. And obviously in this environment that interest rates are volatile, and we saw very recently the hit in other sort of asset classes, having some ammunition against the cycles is very, very important, and we see that across Europe. So bringing the factories in help diversify the top line significantly. I think investors like that. It's by default return on equity accretive because none of these banks issue shares, and I'm sure they will build further on the net income of the businesses they brought back in. And ultimately it goes back to what Alex and Iason said, that the system is tremendously undervalued. It's 8 times earnings roughly, 8.2 versus 10.5 in Spain, 9.5 in Italy. If you get to improve your ROE, ultimately, soon, the macro story, continues getting resonated very well, and the implied cost of equity will drop, which means that the stock prices will drive further up.
So you concur that the current stock prices for Greek banks reflect also the assessment for changes in the macro environment. They have already reflected that.
No, I think that they haven't.
They haven't.
The implied cost of equity shows very evidently that it hasn't. The cost of equity of the Greek banks need to be at least at par or even inside the Italians, which is not the case. There is a very big spread.
Okay. So we identified that the momentum for Greek banks is at the highest level for a lot of years. And the question now, the last question for you, Iason, is that we have the new offerings. We have stock appreciation, low NPL ratios, strong capital buffers. And Greek banks now have a capacity they never have, they have years to have, a capacity not just to distribute dividends, but a wider capacity to manage capital. So just to go to a wider concept, the capital allocation policy concept, how Alpha Bank is going to implement the capital allocation policy?
Okay, I think that all banks view capital allocation in kind of a similar framework with slightly different expressions. It's based around 3 pillars. The first one is around organic growth, and as Alex mentioned, predominantly the discussion there has been around balance sheet growth for a number of years. Simultaneously, there is a growing structural opportunity beyond balance sheet growth. We're investing heavily in technology in order to drive revenues and innovation and bring efficiency improvements. We're building new capabilities. We're developing our product factory. So there's a broader overarching strategy of enhancing our cross-selling capabilities and growing the share of wallet that we have with our clients, even in an organic nature rather than just inorganically. So to put it in perspective, Alex spoke about 13-14% loan growth for the Greek banking system. If you look at Alpha Bank, for example, fees on an underlying basis are growing by 20% this year. So together, those things are driving the earnings growth that is the basis of the investment case going forward. The second pillar relates to shareholder remuneration, right, and ordinary distributions. 2 years ago, Greek banks reinitiated dividend payments after a decade-long hiatus. We've seen growth in payouts ever since. This year we expect to pay out 50% of our profits, close to 450 million, with interim dividends already paid in most cases a couple of weeks ago. Clearly Greek banks have the capacity to go higher, not only because of earnings growth, but also on account of higher payouts. The capital generation capacity that we have as institutions on account of the profitability levels that we see, allow for higher payouts in the coming years. And then maybe beyond the organic growth and the kind of ordinary distributions, we're lucky to start with a position of strength in terms of having accumulated excess capital. We've optimized our capital stacks in most cases. We've got good buffers in terms of capital in line with European peers. And that means we've been very active on doing bolt-on acquisitions in most cases. We've got plenty of firepower to do more. Opinions kind of slightly differ here between the four institutions. I'm personally of the view that extraordinary dividends are not yet on the agenda. With the regulator, we're still in the process of normalizing ordinary payouts, so unlikely we can talk about extraordinary things. But we're still considering bolt-on acquisitions under strict criteria. So they need to be PS accretive, they need to have a good strategic fit, limited integration risks. They need to have a 15% return on invested capital and be accretive to the organization. So in summary, the first pillar is always and will continue to be growth. The second one is to establish robust shareholder returns. And the third one is to use excess capital to accelerate the strategic ambitions. I think this is a kind of balanced approach that we have as institutions to deliver sustainable value in a sector of strength.
Okay, thank you very much. We have been very efficient with time, so that leaves 1 minute for each one of you. If you want to use it for a final statement, I will start just to switch again, George, with you.
Well, maybe 20 seconds because we captured the M&A point. The only thing I would make is that irrespective of whether there is a further strategic acquisition, whether UniCredit does or does not ultimately get to 100% of Alpha Bank, the important thing is that the fundamentals are there. There is no banking system in Europe that poses the attractiveness of the Greek one. So there is a lot to be achieved in the capital markets, even outside a potential acquisition. And I think all the numbers point to that direction, and that's very encouraging.
Jason?
I'll make a slightly personal comment. I was listening to you, Alex, talking, and I noticed, although I know that the grammar doesn't completely comply, that you were saying we are going to reduce income taxes, and we're going to see. So we fully converted you now. Hopefully we might owe you a passport, maybe. And my personal hope is that after hearing everything today in this story, you become like Alex Blade and deserve a passport in a couple of years.
Alex.
Well, I already have one, so maybe that explains it. But I think generally what's going on with the Greek story is that Greece is winning back full confidence in markets and regulators. And when it wins back full confidence, that's when you're going to see that really reflected in asset prices. So this road is not complete yet. That's why it's still a very attractive place to invest, as long as Greece stays on the course. If Greece stays on this course, it's going to keep moving ahead and rising for a very long time.
Thank you very much. So I think that I want to focus as a final statement from my side that the summary is that we have a very healthy banking system, which is always the pillar of any economy, and this aligns with the changes and significant transactions that have taken place in the Greek stock market and have taken place not only in traditional sectors and industries, but we've seen now transactions concerning the sectors of defense, the sectors of licensed lottery and gaming, of course energy and infrastructure, which was of course more traditional asset classes in the past as well. I think that the dynamics are here and the timing is for the banks. Thank you very much, and I hope that the panel brings something interesting for each one of you.